Are you tired of hearing that investing is complicated or the stock market is only for experts? What if I told you that building your first stock portfolio could be as simple as copy and paste?
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Today, I'm going to show you exactly how beginners can create the perfect stock portfolio with a strategy that's straightforward, easy to follow, and designed for long-term growth. By the end of this video, you'll have a roadmap that you can literally copy and start today. Stick around because the way most people invest is holding them back, and I'm going to show you how to break free. First, let's get one thing straight. Investing isn't about picking the next hot stock or trying to get rich overnight. That's a gamble, and most people lose that game. Real investing is about creating a system that works over time, with predictable growth while minimizing unnecessary risk. So, when I talk about the perfect beginner portfolio, I mean something that's simple, balanced, and proven to perform over the long term. Now, here's the foundation. Your beginner portfolio should focus on diversification. Don't put all your eggs in one basket. You want a mix of companies, industries, and even investment styles. For simplicity, we're going to break it down into three main categories: growth stocks, dividend stocks, and index funds. Each has a specific role in your portfolio, and when combined, they form a solid base that's beginner-friendly but powerful. Let's start with growth stocks. Growth stocks are companies that are expanding quickly and have the potential to increase in value faster than the market. Think of tech giants, innovative healthcare companies, or renewable energy leaders. These are the companies that can turn small investments into significant returns over time. But here's a key. Don't go chasing the newest startup that everyone's talking about. Stick to well-known, established companies with strong growth records. For example, companies like Apple, Microsoft, or Amazon might not be cheap, but they're proven performers. You don't need to buy a huge number of shares to start, just small, consistent investments every month. Next up, dividend stocks. These are companies that actually pay you money just for holding their stock. That's right. Imagine owning a stock and having it pay you every few months. Dividend stocks tend to be more stable, usually in industries like consumer goods, utilities, and healthcare. These companies might not explode in growth like tech stocks, but they give your portfolio a steady backbone. Some good examples include Johnson & Johnson, Procter & Gamble, or Coca-Cola. By reinvesting those dividends, you can take advantage of compounding, which is one of the most powerful tools in investing. Finally, index funds. If you're new, index funds are your secret weapon. They're basically baskets of hundreds, sometimes thousands, of stocks, all in one fund. One purchase gives you exposure to the overall market, which historically grows over time. The S&P 500 Index Fund is the most popular choice. Why? Because it tracks the 500 largest companies in the U.S., giving you instant diversification without having to pick individual stocks. And the best part, it's low cost and doesn't require daily monitoring. So how do we combine all three? Here's a simple approach that beginners can copy and paste. 50% in an S&P 500 index fund, 30% in growth stocks, and 20% in dividend-paying stocks. This mix gives you exposure to market growth, high-potential companies, and steady income from dividends. Over time, this balance helps you ride out market ups and downs without panic. Now let me ask you something. What's your biggest fear when it comes to investing? Is it losing money? Or maybe you feel overwhelmed by all the choices out there. I want you to pause for a moment and drop your answer in the comments. Seriously, I read every comment, and sharing your thoughts can help others in the community too. A lot of beginners make one major mistake. They panic during a market dip. The stock market will go down sometimes. Don't freak out. If you've built a balanced portfolio like this, you actually want those dips because it's your chance to buy more shares at a lower price. Think about it like buying a high-quality product on sale. Would you skip a 50% discount on something you know is valuable? Exactly. Another common question is, how much money do I need to start? The answer might surprise you. You don't need thousands. Thanks to fractional shares, you can start with as little as $50 or $100 per month. The key is consistency. Investing a small amount regularly beats trying to time the market perfectly. Over time, those small amounts add up, and this is where compounding does its magic. Here's a quick tip for managing your portfolio. Set it and review it once or twice a year. You don't need to check it daily. In fact, checking too often can make you anxious and lead to impulsive decisions. Rebalance your portfolio if one category grows too much compared to the others. For example, if growth stocks suddenly make up 50% of your portfolio instead of 30%, consider selling a little to bring it back in line. This keeps your risk balanced and ensures you're staying true to your plan. Now, I want to talk about mindset because it's just as important as the stocks you choose. Investing is a marathon, not a sprint. Don't expect instant results. Patience is your superpower. Think in years, not days or months. If you stick with a system like this, your portfolio can grow steadily. And the best part? You don't need to be an expert or spend hours analyzing every stock. I'm curious, if you could invest in just one type of stock for the rest of your life, would you choose growth, dividends, or index funds? Drop your answer in the comment section. I'd love to see what most of you prefer and why. Before we continue, if you're finding this content helpful, take a second to hit that like button, subscribe, and share this video for more amazing tips. Trust me, the right strategy now can save you years of stress and mistakes later. Now, let's talk about one more thing that often confuses beginners: risk tolerance. Everyone has a different comfort level when it comes to risk. That's why this portfolio isn't one size fits all. If you're extremely risk-averse, you could shift a bit more into dividend stocks and index funds, reducing exposure to growth stocks. On the flip side, if you're okay with a little more volatility for higher potential returns, you could increase your growth stock allocation slightly. The key is to be honest with yourself and stick to what feels manageable. Another powerful tip for beginners: automate your investments. Set up a monthly transfer to your brokerage account and schedule purchases for your chosen portfolio. Automation removes emotion from the equation and keeps you disciplined. Think of it as paying yourself first. When you do this consistently, your portfolio grows without constant decision-making or stress. Let's also talk about mistakes to avoid. Don't chase hype stocks, don't try to time the market, and don't panic sell during downturns. Also, avoid investing money you might need in the next year or two. Stocks are for the long term. If you invest money you may need tomorrow, it's like playing with fire. Keep your emergency fund separate and invest only what you can afford to leave untouched for years. Now, if you're still watching, here's something exciting: the actual copy and paste part. You now know the exact breakdown: 50% S&P 500 index fund, 30% growth stocks, 20% dividend stocks. Here's how to implement it. Choose one fund for the S&P 500 allocation. Pick 3 or 4 growth stocks you believe in, and 2 or 3 strong dividend stocks. Set up automatic monthly purchases and let compounding do the work. You don't need more than this to start seeing real results over time. Think about this. What if you started this portfolio today and ignored the noise? Fast forward 10 years. How much do you think it could grow? Take a moment and imagine it. Now type your answer in the comment section. I'd love to see your expectations versus reality in a few years. Finally, remember, this isn't just about money, it's about freedom, security, and peace of mind. By building a simple, balanced portfolio, you're taking control of your financial future. And the beauty is, you don't need to be an expert or spend hours each day watching the market. Start small, stay consistent, and let your investments grow over time. So, are you ready to start your perfect beginner stock portfolio? Drop a comment below with your first investment choice. Like, subscribe, and share this video for more strategies that actually work. The stock market can seem intimidating, but with the right approach, anyone can master it. You now have a copy and paste system that's simple, actionable, and designed for long-term success. Don't overthink it. Start today. Stay consistent. Let your money work for you while you focus on living your life. Remember, the best investment you can make is in yourself and in systems that grow your wealth steadily and safely.